Test. Hello and welcome back to our lecture series on computational finance. My name is Gregor Weiss. I'm a professor of finance here at Leipzig University, and in these videos I try to explain to you the details of modern computational finance and computational methods that are used in option pricing, asset pricing, portfolio theory and other topics in finance. In this latest video I want to continue the discussion of Markowitz portfolio theory, and in particular we talk about the N securities case. In the previous video I talked about the two security case where we had, for example, two stocks and we could combine these two stocks in a portfolio. Now we have the N securities case, and actually it's just a very simple generalization of the two securities case. So first we start with the two metrics we are looking at. First, the portfolio return, that is RPF, portfolio, and it's just a linear combination of all the individual returns of the N securities, weighted with the portfolio weights x1, x2, x3, up to xn. What this means is, for example, that we put 10% in the first stock, 5% in the second stock, 2% in the third, and so on. So these weights are all non-negative, and they should add up to 1, which is only, which means that, for example, we don't allow short selling. If weights were negative, it would mean that we would short sell the respective stock, and we don't have borrowing or lending, so we have a fixed budget that we can spend on our N securities. We need the two metrics based on the portfolio return, and these two metrics are again, of course, the expected portfolio return mu PF, which, because the expectation operator is a linear operator, this is just the linear combination of the individual expected values, expected returns, mu I. And we need the portfolio variance, and in this case, this is a little bit more complicated than in the two securities case, because we now have the sum of xi squared times the variance of the ith security, and now we need to look at all the permutations of the covariances. So we need 2xi xj times the covariance between I and j, but we move from, for example, 1, 2, 1, 3, 1, 4, 1, 5, up to 2, 3, 2, 4, 2, 5, 3, 4, 3, 5, and then 4 and 5. Why? Because if you take the covariance between 1 and 1, this is just the variance. We already have that in our expression here. And the covariance between 1 and 2 and 2 and 1 are identical, so we don't need to put this here in the sum. We can just multiply it with 2. So this is the variance of the portfolio return, and these are the two metrics that we need. In the N securities case, we'll first look at a very simple idea, and we call this naive diversification. This is the case where we simply put all the weights equal to 1 over n. So we put, for example, when we have 10 stocks, we put 10% in each of our stocks. Let's analyze this case of naive diversification. And actually, if you go to SSRN or I think Science Direct, it's an Elsevier journal, there is a publication just a couple of years ago that showed that naive diversification isn't that bad in practice. But as we can see here from our theoretical analysis, there's actually a limit to what we can achieve via naive diversification, because it doesn't really exploit the correlation structure between the individual stocks. So let's calculate and let's define V bar of our N stocks just as the average variance, and C bar as the weighted average covariance between the returns. And if we now calculate the portfolio variance again using the formula from the slide before, we can write this as, with some algebra, as 1 over n times the average variance minus the average covariance plus the average covariance. What this means is, if we, for example, say, okay, we have a portfolio of 5 stocks, and 10 stocks in our portfolio would be better, it would be better diversified naively, Let's go with 500, let's go with 1000 stocks, let's go with all the stocks in the world. So n moves to infinity and 1 over n goes to 0. And then the first term in this expression will vanish and it will converge to 0. And what you are left with is the average covariance. This means, in the case of naive diversification, you will always end up with the average covariance. And if the average covariance is 0, okay, this means that all the covariances are 0, but it might actually be that you always end up with a certain risk of the market. So here, with increasing n, the first term of the variance vanishes. The variance of the naively diversified portfolio is reduced to C bar, and this is also later on called the systematic risk of the market. So this is naive diversification, and later on we will show that in Markowitz portfolio theory, how it's done there. If you exploit the correlation and covariance structure between the individual securities, we can actually get a much better diversification that isn't happening just by chance, because we selected 10 stocks and we went 10% into each, but we are exploiting the fact that some stocks co-move with each other more or less, and vice versa. So this is the N securities case in a nutshell. In the next video, we'll start with the efficiency as it is defined in Markowitz portfolio theory. See you next time.